Could it be that the financial markets got a little too excited, a little too soon? Kind of like the Eagles fans during the first half of the Super Bowl against us, the Chiefs, but then, we came roaring back in the second half, took the lead, and ended up winning the game. And now the word on the street I've been hearing is that some of you think that the game was rigged or that it was some sort of a setup. But you know what? How about this? Instead of crying, why don't you get yourself a new team and start rooting for winners instead of losers?
Excuse me, Mr. Producer here?
Yeah, what's up?
Since when do you watch football?
I've always have.
Yeah, it just sounds a little weird when you talk about sports. Have you always been a sports fan?
I always have. What's with all these questions?
No, nothing. I just think you sound a lot better when you talk about the business, economy, and so forth. We're not a sports channel now, are we?
No, I just wanted to say that we won fair and square. It was a tough game, but we made it happen. And sounds like I'm getting a little too distracted here. Anyways, welcome back, guys. My name is Vitaly with Moskolenko Brothers, and in today's video, we will put sports aside and are going to attempt to feel the pulse of today's economy. There's a lot of optimism that has been stirring up in the markets. Today, we will try to determine if that optimism is based upon solid fundamentals or if it's merely speculation and everyone is dancing while the music is off. Before we begin, please take a moment to like and subscribe. First of all, folks, let's be honest. The inflation report for January that was released on Tuesday was, how should I word this? Well, it was pretty mixed. It was one of those reports that you couldn't call bad, but you couldn't call good either. It was awkward and the report showed very little optimism or excitement. Inflation rose 0.5% month over month and 6.4% year over year, which ended up being higher than what the economists were predicting. The economists hoped for 0.4% for the month and 6.2% year over year, which didn't happen. In fact, on a monthly basis, inflation has increased. Core CPI, an index that excludes food and energy items due to their volatility, also failed to meet forecasts, reporting a 5.6% annual increase against its 5.5% economists' expectations. To be totally frank, I don't know why anyone would be surprised by the latest moderate inflation decrease. Maybe because everyone was too mesmerized by Fed Chair Jerome Powell, who mentioned deflation 15 times during a recent Fed Q&A after raising federal funds rate by 25 basis points. To his credit, Powell also mentioned that the road to bringing inflation to its 2% target is not going to be smooth and that future rate hikes will be necessary, but investors don't care and the stock market has been ripping since then. As long as there's a little light at the end of the tunnel, it's usually more than enough to fuel spikes in the markets. Back to the point I tried to make earlier. Anyone who follows inflation data closely and reads past the headlines is not surprised by the recent CPI report and knows that victory over inflation beast had been declared prematurely. Let's take a step back and look at the inflation data for the month of December. Pretty much all the drop in inflation data has come from declining energy prices and used cars. Everything else is positive. The reason the energy prices have fallen is that the Biden administration dumped over 200 million barrels of oil from the Strategic Petroleum Reserve. To put this into perspective, approximately 40% of the reserves have been drawn down in less than 2 years. This is more than all of the former presidents in history combined. Now that the current administration is no longer dumping tens of millions of barrels of oil on the open market, energy prices are bottoming and are now starting to turn up. On top of all this, now that China is no longer in lockdown, the demand for oil is starting to increase and so are the prices. I have noticed the higher gas prices at the pump already where I live. Now, let's take a deep dive into Tuesday's CPI report so we can understand where things stand. According to the Bureau of Labor Statistics, the index for shelter was by far the largest contributor to the monthly all items increase, accounting for nearly half of the monthly all items increase, with indexes for food, gasoline, and natural gas also contributing. The food index increased 0.5% over the month, with the food at home index rising 0.4%. The energy index increased 2% over the month, as all significant energy component indexes rose over the month as well. The index for all items excluding food and energy rose 0.4% in January. Categories that increased in January include the shelter, motor vehicles insurance, recreation, apparel, and household furnishings and operations indexes. The indexes for used cars and trucks, medical care, and airline fares were among those that decreased over the month. The all items index increased 6.4% for the 12-month ending January. This was the smallest 12-month increase since the period ending October 2021. The all items excluding food and energy index rose 5.6% over the last 12 months, its smallest 12-month increase since December 2021. The energy index increased 8.7% for the 12 months ending January, and the food index increased 10.1% over the last year. To say that this report makes the Federal Reserve nervous would be an understatement. Sure, one might say that the pace of inflation is slowing and that it's a big victory, but let's not forget it took the Fed 8 rate hikes, raising the federal funds rate from near 0% to 4% and 3/4 in less than a year, while also draining over $500 billion in assets from its balance sheet. It's now clear that the Fed will have to do a lot more damage going forward, and 50 or even 75 basis point rate hikes could be on the table without a doubt. Again, inflation is not going away as easily or as fast as some may have anticipated, but lately investors have been ignoring or discounting inflation altogether. Now is not the time to be complacent, and investors need to plan for a potential rise in inflationary pressure. This means diversifying portfolio with asset classes that may benefit from higher rates of inflation. It also means watching out for high-yield bonds that are more sensitive to inflationary pressures and staying away from companies heavily exposed to rising input costs. Now, let's shift our focus to the average Americans, because at the end of the day, regardless of what the Fed or politicians say or how the markets behave, sometimes the best economic indicator is the state of being of the average American. A recent report from Lending Club showed that as of December, 64% of Americans were living paycheck to paycheck, up from 61% a year earlier. For the first time, more than half of all six-figure earners also said that they are stretched too thin, a jump from 42% a year ago. All this, of course, is because of higher inflation, forcing people to scrape for everything they have just to be able to make ends meet. Big brain Wall Street went out to give folks who are struggling financially this genius advice, suggesting that if you want to save money, you should skip breakfast. I mean, what in the world? It sounds like a financial hack that's been used by billionaires who don't want us to know about it, but now Wall Street Journal is breaking the news. Wall Street Bets said it better. Poor? Have you tried starving? Seriously, if you're wondering if things are really that bad, this article says it all. According to the Bureau of Economic Analysis, the rates at which Americans are saving money have dipped close to an all-time low. The personal savings rate was 2.3% as of October 2022, down from 7.3% a year earlier, its lowest level since July 2005, when the rate hit a record low of 2.1%. The personal savings rate, measured by the Bureau of Economic Analysis, shows how much of Americans' after-tax or disposable income is left over after spending for bills, food, debt, and everything else. So far, it has been approaching record lows. Of course, on top of all this, credit card debt hit another record high. In the last quarter of 2022, credit card balance increased by 61 billion to 986 billion. The share of credit card users making payments that were at least 30 days late, also known as early delinquencies, rose last quarter to 5.9% from 5.2% in the prior quarter. The share of serious credit card delinquencies, which represents payments that are 90 or more days late, rose to 4% last quarter from 3.7% in the prior quarter. According to the bank rate, credit card APRs remain at 37-year highs. Rates are nearing 20%, the highest level since 1985. Of course, as the Fed raises rates, it becomes more expensive to carry that credit card debt, leading to more delinquencies. So, to answer the question that I mentioned at the beginning, could it be that investors got a little too excited a little too soon, especially after the Fed's announcement that they would hike rates only by a quarter? I think the latest CPI report says yes, and we are nowhere near being out of the woods yet. All factors considered, it's wise for investors to watch this inflation metric closely and to plan for a future of higher costs, while we, the average folks, will skip breakfast to save money or maybe starve. That's all I got for you today. If you watched this far, thank you for your time. I will see you on the next one. Stay safe and stay informed.